There is a number floating around the energy world right now that sounds almost unbelievable. $12 billion in 2025, $115 billion by 2033, roughly 30% annual growth. On paper, that kind of expansion turns green hydrogen from a niche decarbonization tool into one of the fastest growing industrial markets on Earth. But here's the real question, and it's the only one that matters if you care about systems, economics, and survivability. Is that growth real? Or is it another projection built on assumptions that collapse under stress? When you see a forecast like 12 billion to 115 billion in 8 years, the instinct is to focus on the percentage. 30% CAGR sounds explosive, but systems thinking forces us to slow down and ask what exactly is being measured. Is that hydrogen sales revenue? Is it electrolyzer equipment? Is it total project capital expenditure? Is it subsidies flowing through tax credits? Market size in these reports often blends production value, infrastructure spending, equipment sales, and long-term contract estimates. So the first layer of evaluation is definitional. What is this 115 billion actually counting? If the majority of that projected growth is capital expenditure on electrolyzers, storage tanks, compression systems, and renewable build-out, then the number reflects investment momentum more than hydrogen utilization. That distinction matters. A market can grow in capital intensity without growing in economic viability. We saw that in early solar markets before grid parity. We saw it in biofuels. We saw it in battery factories during subsidy waves. Growth does not automatically equal durability. Now let's ground this in cost anchors because the green hydrogen story always comes back to dollars per kilogram. The global narrative for green hydrogen viability revolves around one number, $2 per kilogram. In some industrial contexts, maybe $2.50, in others, closer to $3. If renewable electricity costs fall low enough, electrolyzer CAPEX declines fast enough, and utilization rates stay high enough, green hydrogen approaches that band. But here's the structural problem hidden beneath the CAGR headline: utilization. Electrolyzers are capital-heavy assets. Their economics depend on running consistently. Yet renewable energy, particularly solar and wind, is intermittent. If an electrolyzer runs at 30 to 40% capacity factor, the levelized cost of hydrogen rises sharply. So when a forecast assumes a 30% annual market expansion, it is implicitly assuming that either utilization improves dramatically, electricity becomes extremely cheap, or policy frameworks subsidize the gap. And this is where the system's economics lens becomes critical. The growth projection assumes that renewable build-out continues at scale. Grid integration challenges are solved, permitting timelines shorten, and capital remains available at tolerable rates. But the energy system is not expanding in isolation. AI data centers are increasing electricity demand. Electrification of transport is adding load. Industrial reshoring is tightening grid capacity. In many regions, grid interconnection queues are years long. So if green hydrogen production competes for renewable electrons in constrained grids, the growth trajectory is no longer just a hydrogen question. It becomes a grid allocation question. Now let's introduce the time axis. Between 2025 and 2033, several system pressures will evolve simultaneously. Interest rates may fluctuate. Carbon pricing mechanisms may expand or stall. Subsidies such as production tax credits could be revised by political cycles. If the projected 115 billion depends heavily on policy stability, then the forecast carries regulatory risk. Markets underwritten by subsidies can grow rapidly, but they can also contract quickly when incentives change. Consider the competitive edge test. If subsidies drop, prices fall, and utilization misses targets, who survives? Large integrated energy companies with strong balance sheets and diversified revenue streams can absorb delays. Pure-play electrolyzer manufacturers dependent on aggressive scaling may struggle if order pipelines slow. Industrial buyers locked into long-term offtake agreements have an advantage over speculative production projects hoping for spot market demand. The 30% CAGR implicitly assumes that demand materializes. But demand in hydrogen is not consumer-driven. It is industrial and contractual. Steel plants, ammonia producers, refineries, and heavy transport fleets must commit to purchase volumes. Without binding offtake agreements, production capacity announcements remain theoretical. Historically, the gap between announced hydrogen projects and projects reaching final investment decision has been significant. That implementation gap is rarely visible in glossy market forecasts. Let's move to the space axis. Where is this growth expected to occur? Europe, driven by decarbonization mandates and carbon pricing, has aggressive hydrogen strategies. The United States has incentive structures designed to stimulate production. Parts of Asia are positioning for export markets. But regional realities differ. Renewable resource quality, land availability, water access, grid constraints, and industrial clusters vary dramatically. A $115 billion global market does not mean uniform opportunity. It likely concentrates in regions with strong policy frameworks and industrial demand anchors. Now introduce system stress. What happens if renewable build-out slows? What happens if critical minerals for electrolyzers face supply chain constraints? What happens if natural gas prices drop significantly, making blue hydrogen more competitive in certain markets? What happens if carbon pricing remains politically unstable? The green hydrogen growth curve is highly sensitive to these variables. That sensitivity doesn't invalidate the forecast, but it introduces volatility. Another layer often overlooked in CAGR narratives is cost of capital. Green hydrogen projects are capital-intensive. Electrolyzers, renewable generation, compression, storage, pipelines – these are not small investments. If interest rates remain elevated or financial markets become risk-averse, the weighted average cost of capital rises. Higher capital costs directly increase levelized hydrogen costs. In a tight capital environment, projects with weak offtake certainty struggle to close financing. So, is 30% annual growth plausible? Yes, in relative terms. Starting from a low base, emerging industries can scale rapidly. Solar and wind experienced similar explosive growth phases, but those industries crossed clear cost thresholds relative to fossil alternatives. For green hydrogen, the crossing point is more complex because hydrogen competes not just with fossil fuels, but with direct electrification, efficiency improvements, and alternative decarbonization pathways. Now consider sector-specific demand. In ammonia production, hydrogen is already a feedstock. Replacing gray hydrogen with green hydrogen is a substitution story, not a new demand story. In steel, green hydrogen competes with direct electrification and carbon capture options. In heavy transport, fuel cells compete with batteries. In shipping, ammonia competes with methanol and biofuels. So the growth forecast assumes hydrogen wins enough of these competitive arenas to sustain 30% expansion. This is why broad market size projections can obscure the underlying competitive battles. A $115 billion market does not automatically imply that all green hydrogen companies thrive. It means capital flows into equipment, infrastructure, and supply chains. Survivors will be those with utilization edge, cost of capital edge, demand lock-in edge, system simplicity edge, and time to deploy advantage. There's also a subtle distinction between hype cycles and structural demand cycles. Early hydrogen announcements were often driven by net zero enthusiasm and corporate signaling. Over time, that enthusiasm must translate into operational projects with real molecules flowing. The difference between a press release and a plant commissioning is execution. Market research reports typically extrapolate from policy commitments and announced capacity. The question is how much of that pipeline converts to steel in the ground. From an engineering standpoint, cost reductions are possible. Electrolyzer manufacturing scale can drive down unit costs. Balance of plant standardization can reduce installation complexity. Improved stack durability can lower replacement frequency. But those gains take time, manufacturing learning curves, and stable demand signals. A forecast to 2033 assumes sustained momentum across the entire value chain. Let's connect this to the broader clean tech system. AI-driven electricity demand is reshaping grid planning. Nuclear power is re-entering strategic discussions. Long-duration storage is gaining attention. In such a landscape, green hydrogen's role may expand as a flexibility resource, not just an industrial feedstock. If grids with high renewable penetration require seasonal storage, hydrogen can provide system balancing. That additional function could justify capacity build-out, even if industrial uptake lags. But again, system stress matters. Seasonal storage projects require enormous infrastructure and high capital tolerance. The economics depend on spread between low-cost excess renewable electricity and high-value dispatch periods. If that spread narrows due to market reforms or competing storage technologies, hydrogen's grid role weakens. So where does this leave the $12 billion to $115 billion projection? It is not fantasy. It reflects genuine capital mobilization, policy alignment, and industrial decarbonization urgency. But it is conditional. It assumes that cost trajectories improve, utilization rates stabilize, financing remains available, and policy signals stay supportive. It assumes that hydrogen captures enough share in industrial and energy systems to justify scaling. The real strategic question for developers, investors, and consultants is not whether the global market hits 115 billion. It is whether individual projects survive stress. A project can exist in a rapidly growing market and still fail if its electricity price is too high, its utilization too low, its offtake too uncertain, or its capital cost too heavy. And this is exactly why execution discipline matters more than headline growth rates. Understanding project finance structures, risk mitigation tools, contract design, and techno-economic modeling becomes essential. Growth projections attract attention. Bankable models create assets. If you're serious about operating in this space, not just watching from the sidelines, this is where H2 Hub by Renee Energy becomes relevant. It's built as a structured authority platform for developers, consultants, and investors who need to understand how hydrogen projects actually survive under system stress. Because markets don't reward optimism, they reward survivability. Coming back to the forecast, the 30% CAGR is plausible in a capital mobilization sense. It reflects a world trying to decarbonize hard-to-electrify sectors, but it is not guaranteed in a utilization or profitability sense. Some players will thrive, others will exit. The aggregate number can grow even while weaker projects fail. So instead of asking whether 115 billion is realistic, ask a better question. Under hostile economics, who remains standing? That lens filters hype from durability. And as you evaluate this growth narrative, remember that tools matter. Financial models, risk registers, and sector-specific project templates are not marketing accessories. They are survival instruments. If you want execution-ready planning frameworks, there are structured project finance and energy modeling tools available in the description that support disciplined evaluation without relying on optimistic assumptions. The green hydrogen market may indeed expand from $12 to $115 billion. But the real story is not the number. It is the stress test behind the number. Growth that survives capital tightening, policy shifts, utilization volatility, and competitive pressure is real clean tech growth. Growth that depends on perpetual subsidy expansion and perfect execution is fragile. The next decade will not simply reveal whether hydrogen scales. It will reveal which hydrogen strategies were built on system resilience rather than narrative momentum. And that distinction will define who captures value in a market that, at least on paper, is growing at 30% per year.